Well, welcome to the Mentis podcast. Today, our guest is Jason Yarusi, a multifamily investor, founded Yarusi Holdings, and he has over 1,900 doors that he's acquired over the last few years. And today, we're going to get into some of the current events with Jason, and I appreciate you being here.
Hey, I'm excited to be here. Thank you for having me.
So, I think as of right now, it looks like the House is going to go and is going to be flipped and go to the Republican side. So we might have a little bit of gridlock here in DC. How do you think that ties into, the macro environment of real estate right now?
Well, it's still going to take a little way to unwind, right? And so when we look at really the lending market likes comfort, likes consistency, right? They don't like the uncertainty, and so uncertainty pushes the variables and makes it harder on people like you and myself to really lock in where we will intend to be on projects, not only today, but a few months out, right? And so ultimately, it's just today is going to be uncertain, but likelihood of once we get a decision, we have to allow the few months to happen here where we find some consistency, similar like what we had in COVID, right? COVID started out of the gate, and when you saw COVID happen, just so much uncertainty out there in the markets. Lenders were pulling back because they just do not like the chaotic approach. But what happens is that if the same happens continually, that we understand of the inconsistencies, then they get used to it, and then they come back to the table and start lending again. So the same thing will happen here, where we'll start seeing lenders get more comfortable with the current economic environment, and once they do, they'll come back to the table and won't be so much standing on the sideline with their pencils down, waiting to see the dust settle.
Yeah, we've seen a lot of the lenders kind of pull back from the market here recently, just kind of taking that wait and see approach. So what do you see happening with the lenders in the next six months, 12 months? What do you think the Fed's going to do? Do you think we're going to see a couple more interest rate hikes? Kind of maybe unpack that for us.
So we definitely will see some more hikes, right? At this point, for them to say like we're going to stop will be a very big transition. Now, again, you can only take things that they say with a grain of salt, right? Because they're trying to, one, provide guidance, but also two, either empower us or punish us. Right now, trying to punish us, right, in terms of what their words are, to try and say stop going out there, stop spending, stop doing things, stop growing, right? That's what they're looking for right now. So with that, it's part of their actions and another part of their words. And with their words become powerful is because really they're limited on the options they can do. Right, they can print more money, right? They're in that part. They can push to have more money print. They can push on change up rates. There's few things that can happen right now for them to do, minus them to go out there and threaten us with what their move will be. So we'll have some more rate increases. It will just be how big of an increase will it be. We figure we're gonna have another 75, but if we have another 50, right, and we see a couple 50s coming out there and they start to trail down, or will they keep really the foot on the pedal and really push things to a destination here? Now, the hard thing is it's hard to gauge, where we have a lot of we have a lot of signals for them that are either lagging indicators. So for them, it's hard for them to predict what's the right moment, right? Because that would be the easy thing. If they could predict, if I do this, the result will be this, right? So for us, it's trying to understand what they're doing, but then also making a lot of consistent local relationships with local banks, regional banks that we will have a better approach with, at least in the short term, because they're lending more off relationship in their balance sheet and less off all of the changes that are happening out there in the market.
Okay, so a lot to go over there. Your local lender is probably going to be a little bit more friendly, going to know the market. What's your approach right now? Are you looking for fixed rate debt? What's the way to position your assets right now in a way to avoid any more heartache? Kind of just hold on, get through this, and let the market stabilize. What are you looking for? What loan product?
So ultimately with local banks right now, the best case is that we get a 5-year term with potentially a year of IO, depending on the project right now, and get amortization out to 25, right? That would be our key. That's what we're going for here. And if we look at that, we'd love to get a fixed rate. And that fixed rate may be a little bit higher here than we'd be exposed to on a variable rate, but in the short term, it gives us a good window of 12, 18, or 24 months to be proactive in our decision making. The big piece of the puzzle is not to have a prohibitive exit from these lenders. And where you could lock in other loans, right, like a Fannie or a Freddie, you want to be careful, because typically the prepayment penalty to exit on the loan, if the market changes, right, in our favor in the next 16, 24 months, well, it's going to be hard to get out of that loan. And when it does change, then our ability to go and potentially even sell with an assumption is going to be hard to do, because people can go to the market and get a better loan than we have existing today.
So what have we learned? I mean, what's the takeaway here? I mean, a lot of people were really enjoying the good times and probably signing up for loans that were maybe a little too aggressive, maybe not paying for that interest rate cap, or not fixing their debt. What's the takeaway here, so that we're prepared? And then kind of going forward, is there anything that you could implement or are planning to implement on your new project so that you're better positioned in the future?
We've always been having our head on the swivel with banks. We've worked with a lot of different groups, a lot of different lending groups, because that's what you have to do, right? You cannot assume one lender is going to be the right fit for everything. And so going forward, it's got to be continued on that approach. From a learning standpoint, it's honestly always having longer term debt, cash flow, reserves. If you can model in to have those three and have that be producing on each property, it gives you the best flexibility. But the bigger piece, now I've learned this lesson a few years ago, is that the prohibitive exit penalty, right? That's where you don't want to get tied into now, is that if you're going to make a choice and say you can get into a loan, and there's two different options. One may be a loan with maybe an agency that is potentially 20 or 30 bips lower in the interest rate compared to a local bank, but they'll have yield maintenance or a large step down. Well, I don't want that today. And on the state of projects we're in, because I do believe we're going to see some relief within the next 12 months, maybe, but coming into 18 months from now, I want to have the ability to get out of the loans I'm in if it is the right time for the project.
Yeah. So, taking that prepayment and keeping that in mind, are you trading off? You're going to trade off for more expensive fixed rate debt at the moment? Or are you looking for, maybe going lower leverage on new projects? What are you doing to keep it moving forward? Or are you kind of hanging tight at the moment?
No, there's opportunity out there. So what we are looking at is there's always a trade-off, right? So if you go into a loan and say you go with an agency lender, you're going to get 30 years amortization, right? You'll be able to push in that. You might be able to get exemptions for 35. You'll get more IO periods, right? So potentially you'll get 12. You could get up to 60 months or more for IO, right? Depending on the project there. However, on the sound side, you'll have potentially a lower interest rate. So it's going to help you on that factor. But you'll have a longer term, and then past that, but you'll have a higher prepay or yield maintenance or something that will be a more difficult exit on that loan. With the local lender or a community bank, you will have a fixed rate that will potentially be higher than the agency loan. You'll have usually a shorter term, right? They're probably going to max out at 5 years. They might want to go only to 20 years amortization or 25 years amortization. Interest only will probably be capped at 12 months if you get any. Maybe you can stretch that to 18, maybe 24, but really 12 months is probably where I could feel safe with. But the exit penalty might simply be either a fixed amount, or it might just be a point, or there might not be one, right? And so there's the opportunities on both sides where you have to look at the risk and reward of both, right? Do you take a lower payment, more interest only right now, but you're stuck? Or do you go with a local bank where you'll pay a little bit more? You may amortize a little bit earlier. However, you do have the ability to move and do other loan products if timing is right, or timing comes in our favor.
That's right. Yeah, I think it's always important to protect the downside and keeping that in mind when you're making those decisions. And I think if kind of breaking that down for us, let's pivot a little bit towards kind of maybe some opportunities that are coming up. And we were just recently on a phone call with one of our property managers who shared that they have a property who's got an income of let's just, for this conversation's sake, let's say it's $100,000 a month, and their debt service is now $110,000 a month. So these are really going to be out of whack. There's a lot of properties that are out of whack on debt service, coverage constraints. I think the lenders have been a little flexible here, but just because everything's happened so fast. But do you see some of those properties coming into the market as potential acquisitions? Do you think some people are going to just need to raise more capital? What do you think is going to happen with that? I mean, the banks seem to have a lot of capital to kind of keep this ship afloat, but some people might be in trouble here in the next few months.
Yeah, and well, that's what it is. The next few months, right? Typically, if people are at trouble today, they were already in trouble, right? So on that fact, they were already in trouble with their properties. So the next few months will say a lot, and will also say a lot to what's happening in the economy, right? If we start to see the tide turns and things settle down, and there's more opportunistic plays, right? I think the treasuries, we just saw the treasuries dip today, right? So if that continues to move in our favor, it might add some breathing room for these properties, but it will happen, right? If you have a real aggressive business plan and the business plan was not able to meet, and we've seen a couple months here of, we'll say, rent dips, and you're not getting the aggressive rent bumps that you modeled in, and you need that to be able to match your business plan. On top of that, the interest rates have risen at a much higher rate, and you're coming into a refinance, and you were modeling a refinance at a certain cap rate that no longer can be met, or you're not even close. Now you're going to be at a certain leverage where you might not be able to get out of your existing loan, and you will be in that response where you may be forced to sell or have to pull in capital, one of two.
Yep. It's going to be interesting to see how some of these people, play it out. If they're bringing in the additional capital, if they just don't have the investor base or liquidity themselves to handle it. I think there's going to be some opportunities there. You kind of alluded to it there with the rent bumps. Based on just some recent statistics we were doing from the U.S. Bureau of Labor Statistics, we're still at around 34% of the U.S. on housing. And in renters' cases, that can be quite a bit more. And how much further do you think we can run on these rents increasing? Do you think we're going to see it slowing down? Do you think we're going to, maybe be market by market? Obviously we have supply and demand to consider in all of those situations. But what do you think is going to be the next next 6 months, let's say, on rent increases across the board?
Yeah, market to market. We like to look at the things that, across the U.S. as a landscape of an opinion. However, market to market is where it's at, right? The areas that are going to have more fall off is that where there's not big drivers, there's not big jobs, there's not job drivers, there's not job diversity, right? So that's not going to be able to bring income that can sustain, right? Because what the growth is, it brings in higher paying jobs, right? Those higher paying jobs can afford, higher rent prices, and then it also can match when most of these markets here at a supply constraint on housing inventory, that will push for the higher rent premiums there. But if you go into markets here where you don't have the job drivers, right, and people are pulling away, we're seeing jobs move out, that's where you're going to continue to see some of this pullback on demand there, because people are not going to have the desire to continue to push and move to these markets, which was pulling them in because of all the jobs that are available in these markets.
So there's quite a few markets across the country that the new home builders are really kind of pulling back on. They had a really robust, I guess, past 5 years in these markets. Any specific markets standing out to you that might look like it might have too much supply coming on, or something that's going to be overbuilt and maybe put downward pressure on rents or sale prices?
These aren't markets that I focus on, so I'm just going to pass off some of the analysis here. But there's some of the markets that really go out to the west, right? So our Washingtons, our Oregons, our Phoenix and Arizona markets, right, where there's just been a huge pull up, right, where a lot of people are coming from California and now are potentially starting to go back to these cities, right? So those are some of the markets that have been overheated. We have markets, a lot of Florida markets that have had a lot of building going on, but will that runway fall off? I'm not sure about the rental markets for Florida, but on the West Coast, there's been a lot of conversation that we're seeing the biggest dips there, right? In the San Jose's, those other pieces here where there were just a lot happening, a lot of money going into those markets right now. And now from that fact, what happens here, development, is that people just stop, right? They just stop the action. They stop the momentum because they need things to settle out, and then the projects no longer pencil out for them to start moving forward at this pace.
Makes sense. So you're staying away from certain markets that obviously have those potential, I guess, pitfalls. So where are you looking? What's the what's the landscape look like for your new investments? Where are you, kind of macro and maybe micro? Some what are the insights on what's the next year look like for you guys?
So we want to be in more affluent markets, meaning that like sub-markets, we'll say that. So we're still very, very honed in on the Nashvilles, on the Atlantas, on certain parts of Louisville, But we want to be in better neighborhoods. We want to be in neighborhoods that are not so exposed to different dynamics, right? We don't want to be in the neighborhoods where the tenant base is working at potentially maybe a Walmart, where they're really exposed to a lack of holiday hours that may give them a good bump of income through the holidays, right? But all of a sudden now, if they have that cutback here where they don't have so many holiday hours or something like that, it really hurts them for the amount of income, and then that transfer how then they can pay rent, right? So we want to be in better areas where the tenant base is a step up, a more qualified tenant base. Even if it's more costly of a product, it also has a more sustainable tenant base, because that tenant base is not as exposed, right? They have better savings, they have better income, they have more consistency in their money coming across, and really just potentially better financial wherewithal.
So we're talking like a B class, A minus level property. Is that kind of where you're looking in markets that have strong demand drivers?
Correct. Like Louisville, we sold out of all of our properties that were in the south side. It was more working class, blue collar neighborhoods. Now our focus is mainly on the east side. The east side predominantly is higher income levels, higher median household income, higher house values, higher all components there. But it trends to have a better tenant base that's going to have more of a backbone through hard times, because they will have money put aside and will have more of a predictable income stream.
So, multifamily's definitely got a good reputation, but some of the more I guess sexy assets over the past few years have been the crypto space, have been in social media companies, and just recently seeing some of this news coming out of Meta. They're laying off 11,000 workers. They've lost over $800 billion in market cap this year. FTX yesterday sold at a major loss. Sequoia Capital completely marking off that entire investment. It kind of reminds me of sometimes that some of these maybe a little bit more boring but sure things might play out a little bit better for investors. Is that kind of ringing true for you in the multifamily? And give us a reaction on any of that going on in the social media or tech markets. I'd love to get your thoughts on where you think all that's going to play out.
We still got a little ways for it to play out, right? I think FTX was one of those companies with Sam Bankman-Fried that most people thought was in a really good spot, right? Especially how they were doing the acquisitions they were doing. It just, I believe, we're in process or it acquired BlockFi, right? And to see that happening where all of a sudden, and it was funny if that story, I think his name's CZ over at Binance, right? He didn't like that Sam Bankman-Fried was saying that he was potentially talking bad to him about to the Securities and Exchange Commission, right? So he didn't like that. So he said he's going to pull out all of his FTT, which was a couple $2 billion worth, right? And so that was that first point, and he threatens to do this, and then that tanks, and there's always fears and liquidity, so everybody starts pulling their money. So there's a big run on the bank, but however, there's no FDIC here with Sam Bankman-Fried. So on that side here, or with FTX. So on that side, it just crushes it, right? So now they're in a liquidity crunch. They go back to CZ for Binance, who they are almost enemies, who now have to become friends, friends and enemies to make an acquisition, which in turn Binance says, well, we'll put a non-binding LOI together, come save the day, which settles the market just for them to pull out and say, you know what, we don't like what it is, meaning that honestly, they don't have enough liquidity, right? They don't have enough cash in the bank to be able to pay people back. So scary thing, right? But that's the quickness of an emerging market, right? And a lot which will still unshake and unravel. The consistency with business plan with real estate is try to keep a business plan, right? That's the piece of the puzzle. Where if you're looking at one property to do a big flip on, another property that you're going to just go and do paint and carpet, another property you're going to do half of it Airbnb, another property you're going to be on a 20-unit property in some remote area, another property you're going to look to buy a very large property spread across a bunch of duplexes in another market, right? You're exposed to your business plan, right? Because your business plan is not solidified. So if you can stay in the approach to stay solidified in markets with a common type of asset, with a common type of business plan, is going to put you in the best place to succeed, because your business plan can overlap to other markets, right? You can have that business plan be very honed in, so you can find the right team to help you carry out that business plan. Focus.
It really just is about focus. And
correct.
You're right. Couldn't agree more on the execution side. Yeah. Well, appreciate all the insights today on where you're seeing the market. And do you have anything else that's going on that you would like to share, and where can potential investors reach out to you, or
Sure.
people learn about your company?
Yeah, I'm sure we probably have this conversation in every 30 days for the next little bit and have a whole different take on taking where we stand, right? So, the piece is just stay calm, make good educated decisions right now, but then react in a way that you need to pivot in as needed, right? For investors, you want to talk more, come over and find us at yarusiholdings.com. Reach out to me at Jason at Yarusi Holdings. Be happy to talk about what we do here in our business and see if we can help you along your investment journey. Appreciate you having me on.
Thank you for your time. Hope you have a good rest of your day.